Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into the first question. Our listener wants to remain anonymous. Let's just call them G and A. That's the initials of their first name. There's a lot of information provided, which is kind of good, but difficult to go through on the podcast. And, I don't want to bore anyone to death. But essentially, Gina, early 50s, 3 kids, one's finished school, two still in school, would like to retire in 2 to 3 years' time and retire in Queensland. The husband works for the private sector and is able to get a PSS pension, which is government defined benefit pension of $206,000 gross. That is likely to be indexed and reversionary. Reversionary means it reverts to the wife if the husband dies, but she gets 75%, I think. I think that's how PSS works off the top of my head. But it just means they've got no market risk, right? So that amount is taxable, although you get a 15% credit. So, you're going to pay a little bit of tax from that 206,000, but it's taxed as PAYG. So, that whatever they receive, there's not going to be any tax liability. Anyway, let's assume that that's enough to, if not pay for all living expenses, at least a lot of them. In terms of other assets, there's 4 investment properties and still some super and cash, as well as cash in offset accounts. So I don't think they're in a very, very strong financial position. So I don't think, it's really about retirement. This is really about sequencing. So they don't really want to sell the family home in Canberra. I think, it's in a good location, but most importantly, they've got a emotional attachment to it, being the home that they brought up their kids. So they prefer to keep it. And so if they do keep it, how do they go about doing that? They expect to receive an inheritance around 2.5 million, and they need to spend around 3 million in Queensland. And they could fund that 3 million, from the inheritance and some cash savings. That would be no issue. Again, the timing around the inheritance will be kind of the issue. The inheritance is coming from their mother, who's 91. So I guess the first question from G&A is, how do we fund the family home purchase? I think my first observation is, let's not really, it sounds really crude, but let's not spend too much time thinking about it now, because, in 2 to 3 years' time, that inheritance might have been received, I guess. I hope not, but, it might have been, and there's an easy solution there. Some other considerations were withdrawing money from offset accounts. So they've got some savings in offset. So you could potentially do that, although I'm not in love with that. I'm not in love with the idea of going into retirement with much higher debt just because you've got an emotional attachment to your home. I mean, I should say, by the way, this is not a judgment of any sort. Approach, whether it's on this podcast or with my clients, is to help my clients make an educated financial decision. So my role is to tell my clients what I think is financially prudent, and then they can overlay the lifestyle considerations. So when I talk like this, it's not about judging to say, oh, these clients are crazy, just sell the house. It's really what is financially prudent. And it's not financially prudent to take a lot of debt, albeit investment debt, into retirement. And I'm just running my eyes down these numbers. They've got really nearly just slightly less than 2.5 mil of investment debt with about 1 mil in offset. So you got 1.5 mil of investment debt against nearly 4 million of property. So it's not that bad in terms of LVR. That'd be getting close to neutrally geared. So that's okay. I can live with that. Like, they don't necessarily need to sell any of those investment properties. And they've got one in Sydney, one in Melbourne, one in Brisbane. All look like to be in good quality locations. And then there's one in Hervey Bay. So I'm not sure about that one. But so maybe from an investment perspective, you might sell Hervey Bay just so you can reduce debt. So I think that's fine. I think they really need to do anything financially to reorder assets or do anything like that, especially they've got the index pension, but it's really sequencing. So the other option they mentioned was to go and rent in Brisbane. I like renting, at least initially, particularly when I've got clients that are making a really considerable lifestyle change. So moving from Canberra to Brisbane. Oh, they said Queensland, actually, not Brisbane. So Queensland. I think it's prudent to go and see how it works first. I've had clients do something different different, like go and do a sea change or a tree change, I tend to say the same thing, or that's difficult in that situation because the permanent rental market is pretty tight in those locations. But, before you go and commit $3 million, let's go and work out whether you like it, whether you can kind of build a bit of a community there, and whether living there is just as good as holidaying there, which isn't always the case. So I like the idea of renting, and maybe in your situation, maybe it's kind of better anyway, seeing that you expect this inheritance, and I guess realistically it could come sort of any time, and that would be the best way to utilize it. In the situation where you hadn't yet received the inheritance and you wanted to buy a property in Queensland, I think I'd tell you to sell the Canberra property, because I don't think I would tell you to withdraw the money. It was the other thing was, should we commute the pension into a lump sum? So what happens if you get a defined benefit index pension? You can take it into cash if you want. If you did that, it means you'd have to pull it out of super firstly. That would be nonsensical. And then you forego, then you're going to take market risk. And I just think if you worked for so long to get the benefit in the first place, the decision not to go for a defined benefit the right time for that decision might have been 30 years ago, but you made the decision. So now it'd be silly to unwind it, and you may as well take the benefit of having a index pension. My father actually gets one of these, and it's put my parents in a great position where they've never need to really worry about investment returns, and they've always had a lot of certainty. So I definitely wouldn't say commute the pension to a lump sum. I wouldn't say go and sell the investment properties. That seems like financially a silly thing to do, because that would be, one of the considerations around keeping the pension that G&A have observed is if when they pass, the pension disappears. Unlike super, when you got a lump sum, when you pass, you can leave it to your dependents. But my counter argument to that would be, well, you've got plenty of other assets, so it's not like the kids are going to be destitute and they're going to receive some benefit. Plus, also, you've got to, I think, make decisions with the priority of you're going to be around on this planet for another number of decades. And so what is the best thing, assuming you're going to, live through to life expectancy or beyond? And so, having that index pension, I think particularly the husband's retiring at 55 or around about that level. So, retiring a bit early means you don't have the issue of eating into capital sooner than most people. Most people retiring at 60. So you wouldn't take money out of super. I wouldn't change having that index pension. I think that's just too valuable to lose. And I wouldn't borrow. I wouldn't increase my borrowings. I wouldn't take money out of offset, because that's going to indirectly increase borrowings. So I think it's really just about timing. And the decision then will become, do we rent and, sort of try before we buy, if you like. And then when we're ready to buy, if we haven't yet received the inheritance, unfortunately, you might have to make the difficult decision to sell the family home in Queensland. A couple other questions G&A had at the end. Each child's going to receive 100,000 as early inheritance. I imagine that's from their mother. What should we do with the funds? Put it in an offset account and give them the interest, or let them invest it? Look, typically it's impossible for me to answer that question because I don't know the circumstances of all your kids. But if I can just comment or make an observation, share an observation that I tend to see is that mostly kids will want to use those monies to get into the property market. Their kids at the moment are 18, 17 and 13. You'd have to say that those children are at least 5 to 10 years away from probably getting into the property market, because they're 5 to 10 years away of having a stable income and decent borrowing capacity. So given that's the investment time horizon, I would invest it in shares, probably a diversified ETF, rather than putting it into offset account. I think offset account, the return's just not going to be, you hope to get a better compounding return. And then also you can hand across those investment portfolios when the time is right, whether they're 18 or a little bit older, and they can start learning about the share market. And it's what I did with my kids. And one's disinterested, one's very interested. So it is what it is. You can't manufacture interest, but at least, it's theirs to start taking responsibility for and learning about. And the final question was, should I set up a self-managed super fund to invest in commercial property? That's a really random question. I don't see, it's funny how people think. I don't really see why you would do that. As I spoke about last week, the whole point of investing and the transition to investing just psychologically, and eating into or decumulating assets You know what? Why? I mean, like, what's that saying? The money's like oxygen, you only need so much. It's kind of true for many people. An extra $1 million isn't going to move the dial. And certainly, I think putting super into a illiquid asset with some borrowings at this stage of life is completely and utterly inappropriate. Notwithstanding, their Gen A aren't going to have enough super to be able to do that unless they commute the husband's index pension, which I've already sort of addressed. So anyway, I hope that helps. I guess it helps people kind of learn about, I guess, sequencing, index pensions, and these sorts of things. Okay, next question. We're going to do something a little bit different. Next question is from Matt, and we have actually gathered asked a few people to record their question in audio. We're going to trial it out, and if it works, maybe it's something we'll keep. Just to break it up, I guess, so you don't have to listen to my boring voice. So over to you, Matt.
G'day, Stuart. Thanks for all your hard work on the podcast and for the opportunity to ask a question. My question is relating to investing in shares on behalf of a child. I had the thought that if you're planning to have an account to invest in shares for a child, you've talked before on the pod about the relative simplicity of opening an informal trust account and then providing the parent's tax file number, who would then just deal with the tax consequences until they turn 18 and can receive the shares. My question was about whether, if a couple's planning to have a discretionary trust anyway to hold their own share investments and whatever else it owns, is there any reason not to just have that trust open a separate brokerage account for each child and deal with the distributions through that?
Thanks. That's a really good question. I guess the answer is that the advantage of having a separate account in the child's name is twofold. The first one is it's segregated. You can clearly identify what are the assets for that child. And then secondly, because it's informal trust, when you transfer the assets into the child's name, there's no CGT. Whereas if you have those or accumulate those assets in a family trust, and then transfer them to the child, there will be CGT or could be CGT. You could potentially deal with that. I mean, depends on the numbers we're talking about, right? Because if you're transferring it to the child, they're 18, they've got no other taxable income. Well, if the discounted capital gains are less than $20,000, then it doesn't really matter. You're not going to pay any tax anyway. So I guess it depends on the amount of money involved and, the time period and all those sorts of things. The other experience I had was a number of holdings, because I managed some money for my kids. And when they were 18, I transferred it to them. But I worked out that I was using ComSec, to do an off-market transfer into their account, they charged a certain fee, $50 maybe per transfer. And I might have had, I don't know, like 8 or 9, 10 ETFs in each portfolio. So, you got to consider the cost as well. In some situations, I just sold the holding and transferred the money to them. But yeah, it could work depending on the amount of money involved. But thanks for the question. Actually, Matt's submitted another question as well. He's asked about a form of debt recycling that some self-employed sole traders use, and particularly some of those sole traders can be people like barristers or medicos, surgeons, and so forth. And it just depends on circumstances. But let me just give you a generic case study without then necessarily, I mean, nothing in this podcast is advice, of course, but there's some pretty heavy restrictions talking about tax saving mechanisms. Almost sounds a bit sort of communist, to be honest. But anyway, let me give you a scenario. Okay, here's the scenario. You've got a very high income earner that is, let's say, a surgeon earning a couple of $1 million a year. They've also got a really big dirty home loan, maybe let's say $1.5 million a year, and they want to repay that as fast as possible. The surgeon gets paid, obviously earn income that's not PAYG, so they're going to have to pay installments, quarterly tax installments on those monies. So, they get, let's say in a quarter, $500,000 of income net of expenses. Let's say they put it into their home loan, and then they get a PAYG installment for, let's say, $200,000. And all of a sudden they go, oh, now I've got to pay this $200,000. If they've put all the money in the home loan, they can obviously redraw it, but then they're going to mix purposes, because if they borrow to pay the tax because it's related to business income rather than personal exertion income, well, even if it's personal exertion, it's still business, it's still sole trader income. That's a better description. They can claim a deduction on the interest that they use to borrow those funds. So you're not going to mix purposes in a home loan. So in that situation, what the Medico would do is go and borrow that $200,000 and then pay their tax bill. And so as a result of pre-committing that income towards the home loan repayment, what the result has been is that they've reduced their home loan by $500,000 and they've increased a tax deductible loan by $200,000. And if they in fact do that regularly, what will happen is they will debt recycle very quickly their home loan. Now, a word of caution, that's not advice. That's not a strategy. I need to say that because otherwise, it can be argued it's a tax and that's not legal. But that's something that if you're in a situation like that, you should speak to your tax advisor because it could be something that, might help you repay your home loan faster. So, Matt, I hope that answers your question in a way that I'm able to answer it. And yeah, I mean, if you're able to do something like that, to my mind, it's typically an advantageous sort of structure. Okay, next question is from River. I probably don't need to give you too much of a rundown of his situation in terms of numbers. Essentially, River wants to upgrade his home, but he also bought a investment property back in 21 in Footscray in Melbourne, which is investment grade property, but the problem is that it hasn't grown very much. Well, welcome to Melbourne. And anyway, he wants to upgrade, and he lives in Melbourne, so it's double-edged sword there because his home probably hasn't grown either. And because of borrowing capacity, he needs to reduce debt. And so he's in the unfortunate situation of either waiting to do the home upgrade until the investment property has enough equity to secure its loans, together with the new home, of course, or use some of his cash to pay down the investment property loan so that he can borrow for the home purchase. And look, I don't know his situation in detail. I haven't looked at the numbers in terms of the borrowing capacity and so forth. But that's how I understand the question. Do I move now and repay tax deductible debt, which obviously has a long-term compounding impact? Or do I wait for the property to grow? And just to put some numbers around, we're talking about $180,000 that we're going to repay. And look, this can be a bit of a challenge, and it's a little bit like, property. I wrote a book many, many years ago, which I hate. It was called The Property Puzzle, and the thesis behind that was it's about trying to put a puzzle together, and it's about borrowing capacity and tax and cash flow and asset selection, and there's lots of different considerations, and it's like a bit of a puzzle. And this reminds me of this situation, if you like. The challenge in these situations is that you want to make the move. I mean, putting aside lifestyle considerations, he's having a second child, well, his wife is, and so obviously, space is an issue, and that's why they want to do the home upgrade. But putting that aside, he's in a situation where potentially he can do a home upgrade in a pretty attractive market because obviously he's probably going to spend more on the upgraded family home. So if you can, okay, sure, he's going to sell in the same market, but if you're spending more than what you're selling, then arguably the percentage gain is better. So better to buy, a really good quality asset that's worth more than the asset that you're selling in a good market. I hope that makes sense. So it's an attractive proposition, except for the fact that it's a really difficult market and there's no equity in the investment property. So what I would do in this situation, or what I consider doing, is I would borrow that $180,000 from family. I would put in place a loan agreement, a formal loan agreement for those monies. I would even pay that family member interest on that loan. And that way you can go ahead and do what you want to do. You wouldn't necessarily disclose that that's what you're doing to the lender. Disclose what you're doing to the lender, that, you're going to borrow this money from family. They probably don't really need to know about that, I would argue. And the benefit of doing that is that from a taxation perspective, you've not repaid the loan, you've just refinanced it to a different lender, the lender being a family member. And at least then down the track, when your borrowing capacity allows and when the equity in your property more correctly allows, you can go and refinance that loan, increase your bank loan and repay your family member. By the way, you might also at the same time gift or lend some cash to your family member because they might want to on-lend that to another family member. Hint, hint, wink, wink, if you know what I mean. The other way you can do it is what we've done before is that we established a family trust. We were going to use it anyway. The client contributed cash into that family trust and we borrowed from the family trust just to create separation from an entity perspective. And we'll pay interest to the family trust and so forth. So again, that was another way of just dealing with borrowing capacity issues, but still allowing us to maximize the maximum tax deductible loan. which sort of accommodates situations where today our borrowing capacity is low, but we expect our borrowing capacity to improve in the future. And so in River's situation, his borrowing capacity is low because of the property values in Melbourne, but assuming they improve over the next 5 years, his borrowing capacity is going to increase. So it's just a way of dealing with that. This is not tax advice. I mean, none of this is advice, of course. You must speak to your registered tax agent, whoever does your tax returns and so forth, and make sure that, it's all above board, it's commercial, the arrangements are sound, whether you do it with a family member or whether you establish an entity like a family trust. But it's just one way to where you've got, again, it's about putting the pieces of the puzzle together. And so it's too much of an opportunity cost to forgo $180,000 of tax deductible loans. Remember, tax deductible loan is really half the cost of a non-deductible one. And so if you repay it, what you're essentially doing is saying, I'm going to pay twice as much in terms of net after-tax interest on $180,000 for the rest of our life. Not an ideal situation, but there might be a way to get around it, River, while you're still preserving the tax-deductible nature, but really just splitting out into a separate loan. I hope that helps. Again, this is not advice blanket advice and go and do it yourself without talking to any professional. You need to sort of run it past your mortgage broker, run it past your accountant, financial advisor, whoever it might be, but something along those lines could work to preserve that loan amount. Okay, next question is from a listener that wants to remain anonymous. Okay, they're mid-40s. He earns 75, she earns 55, returning back to work. 150 super for him, 100 for her. Principal place of residence, because they sold, renovated, and sold multiple properties, upgraded, sold some investment properties, they're in the fortunate situation of having a home with no debt worth 3 to 3.5, which is great. 2 investment properties, one in Western Australia, Perth, one in Brizzy. Okay, so the properties are pretty lowly geared. Like Perth is worth 800 with 250 of debt, and Queensland's worth 900 with 250 of debt with 100 in offset account. And they're really not sure what to do next. And they're asking for my opinion on the properties and also then what to do next. Obviously, they're in a good position, like equity position. I mean, the question that I would ask if I was in this person's situation was, what's the decision? You're mid-40s. What's the decision today that you can make? So when you're 60, you look back and go, well, that was a really good decision. Like, I'm glad I did that. And looking at the property, so the Perth property is about 30-minute drive north of Perth along the coast. And that area there's a lot of vacant land in that area. I think I've looked at it before, and I'm pretty sure there's a lot of vacant land in that location. And it's a new build sort of family home style property. So it's in an area, there's a lot of vacant land. It's an area where, supply is abundant and it's further away from the CBD, of course. The Brisbane property isn't probably really in Brisbane, to be honest. It's about an hour, from the CBD north of Brisbane. So very much on the outskirts of Brisbane. I guess the thing is that I look at this and go, well, firstly, if you looked at past returns, you wouldn't make any decision. Like, if you looked at past returns, you would decide, I'm not going to make any changes to these assets. And of course, this person's benefited from a rising tide that, the location of the property hasn't been the driver of returns, but the overall sort of fundamentals that have occurred in terms of the more affordable locations have outperformed. And those two markets, being Queensland and Western Australia, have also benefited from substantial demand. So I think what we need to do when we look at next best step is we've got to formulate a view on what the future returns of the existing assets will be, and then that helps us inform our decision. And so can we expect a repeat of what this investor has experienced? My conclusion, and other people might reach different conclusions, of course, is no. In fact, if I was in this person's situation, I'd take my money and run. So the two properties worth together are 1.7 million, with about $500,000 of debt and some money in offset account. Yes, by selling these properties, you're going to crystallize a lot of capital gains tax. I get that. But this investor has the opportunity to get rid of 2 average assets and buy one great one. And that's what I would do if I was in that person's situation. The other thing too I look at is their super's relatively low. Mid-40s, they got $250,000 of super together. So really important that these property assets perform. So the risk is that if we keep these 2 assets and mean reversion occurs and they don't see a lot of growth, like who's going to pay in these locations, who's going to pay that sort of money, $800,000 to $900,000 for a pretty basic 4-bedroom family home on a block where land supply is not scarce? Like, I mean, where's the upper limit? I can't see why anyone would pay over $1 million for a house like that, particularly if you can buy something that's in a blue chip suburb for, $2 million. I know there's a big gap there, but relative value, of course. So that's why I think it's important in this person's situation to really make a good quality decision. So that's what I would do. Obviously, I suspect that this investor could make that change and it not really cost them in terms of taking on a lot of debt. Have to take on more debt, but not a huge amount more debt. So once the dust settles on all that, maybe what you do then is you borrow against borrow if your cash flow allowed and you're comfortable to do it, borrow to invest in the share market as well. And on the 8th of this month, I'm going to talk about lump sum share market investing, which would be appropriate if we're going to go and borrow, a reasonable size money and want to invest it in the market. And on the 22nd of April this month, I'm going to talk about how to construct an ETF portfolio. So those two might be really relevant to that strategy. But so that's what I think I would do with that situation. Not advice, of course, just really based on the information that I've been provided and, what I've been able to sort of look at on the internet. But, hopefully that helps. And thanks for submitting your question. Okay, I'm going to squeeze one more question in from Gaz. Really interesting one. I'm a fan of your show and admire your evidence-based approach, but I wonder if sometimes you emphasize evidence to the exclusion of nuanced deviation from best approach per your averages. Your episode 385 suggested that the evidence-based approach to rates never fixed. Based on average, it yields a worse result than variable. We fixed on 11th of November before your episode was released, and as a result, we received an instant reduction in interest rate from, I'm assuming, the variable 5.24 to 5.19. My contention was that we fixed for 2 years with the expectation that the cycle may have bottomed. My contention was that rates, as with stocks, it's possible to do better than the market. Do you think it's reasonable for active investors to make bets like this despite the evidence suggesting that most of the time it will yield a negative result? So Gaz is obviously well in front because obviously we've had 2 rate increases. So he certainly fixed at the bottom and the market is pricing another 3. So good on you. Certainly, I mean, the evidence doesn't suggest that every single time, and I should be clear on this, the overwhelming evidence suggests that if you invest in index funds, that you're going to produce a higher return. That doesn't mean every single active manager has failed to beat the index. In fact, that there's a handful of managers out there that have beat an index for an extended period of time. The problem is it's just like finding a needle in a haystack. And I guess, what I did when I did that analysis is I looked at fixing every quarter. And then I looked at what is the time-weighted average interest rate subsequently and whether that borrower was better off. So I didn't look at, say, every month. I'm pretty sure the rates weren't monthly. I think they were quarterly or might have been monthly. I'm not sure. I'd have to go back and have a look at that. But I mean, there's always exceptions that prove the rule. The issue is, can you predict them? Well, what's worked in your favor, Gaz, is the Iran war and the expansion of oil prices. Would have you predicted that back in December when you fixed? I mean, you could have. I mean, anything's possible with Trump in power, of course, but it's random, isn't it? And I guess the other thing too is not just about money, it's about flexibility, borrowing capacity, being able to switch between lenders, these sorts of things. You only fix for 2 years, so that's not too bad. I mean, to fix is really to try and give yourself some interest rate protection. So the shorter the period of time you fix, the less protection you have and the more it feels like playing the money market. So what do I think? I think good on you. And I don't say that facetiously, of course. Genuinely good on you. It's turned out to be a great decision. But I think, if you were a borrower and you fixed your interest rate, every couple of years, my analysis suggests that you're more likely to be, over the lifetime of being an investor, worse off. And I guess that's what the evidence tells us. That's not to suggest that, you could randomly fix at the perfect time. So, for example, fixing, I think, around 6% just before the GFC ended up being a great decision to make because interest rates really peaked strongly in '06, '07, I think, and '08. But, in a normal situation, fixing at 6%, I go, oh, I don't think it's that attractive. It's really difficult to predict these things. And, I guess it does show that anything can happen. But also, I should say, it's too early to call too, because interest rate expectations can change very quickly. And I'm not saying this is the expected route, although I think it has a high probability, but it's entirely possible that we do get 2 or 3 more rate increases this year and that it absolutely smashes the economy and the RBA starts talking about rate reductions towards the end of this year. So Gaz will be in the money in 2026, as in he'll be better off, but he still has 2027 to run. So it's too early to award a winner. He looks like a winner now, and I certainly concede that. But let's see how interest rates play out, because that's the other thing to be mindful of. Expectations can change. And I guess what we're trying to do with an evidence-based approach is our expectation shouldn't be that we're going to be right every single time. What we need to be right more often than not, and we need to be right on average throughout our investment journey. And so that's what that's what I think an evidence-based approach will do, is that you're not going to be better off every single decision. But if you need to make 20 of these decisions, whether to remain variable or fixed over the course of your, accumulating life or accumulating career, that 18 times out of 20, the staying variable is probably going to be the right decision. But, good on you. And look, I appreciate it. I like people. I'm happy to hear contrary views. I think arrogance in financial planning is the worst thing possible because you won't see all the risks. So you should never go. I mean, it's probably a good attribute to have just through life generally, but certainly with financial advice and financial planning, you absolutely need to hold strong opinions loosely, which means that you've got to have conviction over your opinions. You've got to have confidence, but not to the point where you're blinded to other opportunities or other ways of looking at things. So I love the idea of listeners writing in and saying, Stuart, I disagree. Let's have that conversation, because I think that it's either going to make my viewpoint stronger, or maybe, there's something aside of the coin that I haven't seen. So thanks, Gaz. I appreciate it. And I might leave it there. As I mentioned earlier in today's episode, tomorrow I'm going to talk about lump sum share market investing. And actually, I was talking about this topic with a client this week and admitted I've changed my view on this over the last couple of years. So there you go. Actually, isn't that funny? That's probably an example of, hold strong opinions loosely. But let's look at the evidence behind lump sum share market investing. We'll do that tomorrow. Until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.